Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at NVIDIA, ticker NVDA, and I can finally say that I think I'm convinced on this one now. Things are looking great. So I'm coming up with the fair value around $71, kind of dragged down by the discounted cash flows, but currently it's sitting at $109 a share. It's gone as low as 81, which are higher end of our target range is 83, and it's been as high as 153. So it's a very volatile stock, but the fundamentals here are what really matter, and that's what we're looking at today. So earnings yield 8.12% is pretty good, and we would expect $5.45 in earnings per share for what we're paying, and we're getting that in 2026, according to analysts. They're expecting 444 this year and 569 next. So it is in sight, unlike some of the others that we have taken a look at, but not quite there yet. You know, if we got down closer to our target price, then it would be a lot more reasonable. The earning yield would look better. Cash flow yield does look strong. They had a really strong year this last year, but their average is 33.88%. And if we take a look at the cash flow graph, I now see why our discounted cash flows is being dragged down. It's because there was a down year in 2022, and those two really small years are definitely dragging things down. Once we factor out 2021, so next time we run the numbers, it will most likely look a whole lot better, which is even more bullish, because right now I am almost convinced enough to buy. I feel like $100 might be worth starting an investment at. Dividends super small, not really dividend stock, not paying out much in terms of the payout ratio. So there's room to grow it if down the road they decide to go that route, but they definitely don't have to. I mean, reinvesting in the business, definitely good for them. They're getting super strong returns. ROE almost 92%. And their debt to equity is so low at 0.41. So their margins must be insane, and they definitely are really high. ROI 36% and ROA 65%. All of those are incredible. This might be one of the best companies in terms of returns that we've taken a look at. Debt to equity we touched on. They've got enough room to issue $47 billion more in debt and still be under the threshold of a 1 there. Gross margins, super high this last year, 75.3%. On average, 67.5%. Net, again, super strong year, 56. On average, 39. So I'd like to see those hold and not just have a fluke year. I wouldn't be surprised if they hold, though, with the brand power. PE just shy of 25. Honestly, that's fine for this company, because when we take a look at them, on average, really, for what they are, 25 is not bad. Under 20 would be even better, but we are okay with that. And they're price to earnings growth, 28%, PEG of 0.87, so that's below 1. So on an earnings front, things are pointing to not a bad stock to invest. And now we go down to some analyst projections and then building our thesis for what we think is going to happen over the next 3 to 5 years and what the fair value of the stock would be if that were to be the case. So super strong revenue growth as of late. 69 in the last 3%, 68. We can round it up to 69 in the last 2, but it is dropping off a bit. Analysts are only projecting 55 this year and 38 next. Not a concerning drop-off whatsoever at 55 and 38%. That's why I put 40 for the thesis. It's kind of in between those. If it continues to drop off at that rate, then we might want to lower this a little bit. It's probably okay. Share count, we like to see companies buying back shares, and they definitely are here. What we love to see. That's one of the better ways to reward investors. Cash flows, I mean, if you're getting 40% revenue growth, to hold your cash flows, you'd need 40% growth in that as well. But they did come in well above average, so if they come shy, that's fine. At 35% in 5 years, they'd be looking at 39% for their cash flow yield, which is completely fair based on what we're seeing. Asset growth has been consistently in the mid to high 30s, so 37 seems reasonable. We'll see if they start slowing that down, but there's no signs of that at the moment. In fact, it jumped up over the last 2 years. Liability is pretty low, somewhere in the high teens, low 20s, so 20, of course, is a fair value there for averaging things out. The dividend, I mean, I'd love to see them continue raising it at 10%. We can actually look at the graph and see what's going on there. It looks like they rose it in 2021, held it for a bit, and yeah, they've held it since 2021. So I don't actually think that there's going to be any growth there, which sucks. I mean, I do like a dividend growth stock, but can't win them all. And then margins, flat, slightly upward, 0.01% is absolutely fair here. And what are they going to do? End up getting over 100%? This thesis gives us annual growth of 51% in the fair value. Once you factor in the dividend, you get that extra 0.2. So obviously outperforming the market, that 8 to 10% that we're usually looking for, definitely surpassing that. With the cash flows dragging everything down, this is what we're looking at. But let me do a quick adjustment and switch to the number without factoring in the additional value of the discounted cash flows. So this is what it gives you. More like what you would expect if it's just north of the current fair value, and annual growth is 51%. So I do feel like that is very excessive. I mean, we're saying it's $100 today. In 3 years, it'll be $200, and in 5 years, it'll be almost $400. So if we take these revenues down to, let's say, 30%, and with that, we would drop the cash flows most likely. That takes us down to a bit more reasonable, 37.5%, 162, 271. Much better, still outperforming the market. Let's take this asset growth down to 27. Liabilities. I mean, if we're taking the assets down, we might as well take the liabilities down as well. And everything looks pretty reasonable there at that point. Still, significant outperformance of the market, and you are beating out SPY by a solid margin, 22% in the next 3 years, almost double the market returns, and 100% in 5 years. So triple the market return. That's because there's a lot baked into this number. It's going to take a lot to grow 30%, 30%, 30%. Can they do it? Maybe. But if we knock this down to something even more reasonable, something that we tend to see with other companies, because of course this is what it's going to average out to over the course of the next 5 years. This looks much more reasonable. Still a growth stock, still not bad. And that would give us 18% returns, where in this case, you are looking at underperforming the market a little bit in the 3-year and the 5-year, because you're buying it at an elevated price today. I mean, if we go up to the fair value, I mean, if you were to get into it at the fair value, or even at the 52-week low, things would be a whole lot more reasonable. Yeah, 52-week low, you're still outperforming market. So I do feel like this is the more reasonable scenario. I mean, analysts' expectations are incredibly high, and I don't want to doubt them, but that is a very high bar that the market is looking at. And if they fall short on their earnings, on their revenues, it could be rough. Probably why we see so much volatility in the stock. A lot of people trading it off of the earnings and the futures prospects. So financials look solid here. I mean, everything really has a similar graph. 2022 was kind of the start of everything for them. They dipped down and then just took off in just about every single metric. So we see that on the chart for sure. When we take a look at this, what we're looking at is the balance sheet always bringing up the rear. Tends to be the case for a lot of companies. And then we have cash flows, which we're down here with the balance sheet and have kind of exceeded expectation. They went on to trade above the actual share price this last year, and the share price has just gone crazy this year. But you notice how everything is so clustered at all these different points, and it's just kind of starting to spread out. I mean, everything is up and to the left. Lots and lots of value in those earnings. The fair value is going crazy. Cash flows are kind of leveling off, but that's based on our thesis. Those are future numbers. The story here is, do you trust analysts? If you believe in the analysts, now would not be a bad time to buy. And if they can keep up how they're doing for the next 5 years, then you are in a very, very good place. If you don't believe in the analysts and you think that they're going to fall down to a much more reasonable level, then it's not really truly at a reasonable price at the moment. You'd be good to get in at the lows, so around the $80 mark. But 100 is a bit much. That 20% discount makes a huge difference over the long run, especially if you're buying a significant amount of shares. So what am I doing with this one? I wouldn't mind selling a put around the, well, I'm sure there's strong support at the $100 level. You can tell that there was a stock split here. A 4-to-1 split back in 2021 and another 10-to-1 split in 2024. But when we're looking at this, personally, I'd come in here and I'd see, well, it bottomed out at 94 here, where it also hit a peak over here. So about $95, I feel would be a really reasonable place to sell a put. If I was feeling a little bit more risky, I'd go in and try and find another point where I see a lot of strong support. And on this time frame here, the monthlies, I'm not really seeing that. I mean, of course, I would sell calls up around a bit tougher, super strong resistance up around the 145 mark. That's where I would sell my calls at. I mean, look at that. It's down 2% after hours today. So I'd say this one is a consideration for a portfolio. I'm definitely considering it for mine. RSI and MACD both look good, so it's pretty stable at its current price range. So I would not feel awful about selling like a $95 put. And if I were to get assigned on it, then I wouldn't be too mad, honestly. I can take a quick look and see what the expected premium would be. Yeah, so the probability of profit for selling a $96 put for next week is 91%, and the premium is 37. So 37 bucks buys you a third of a share. Not too bad. And as for this week, of course, it's going to be a lot lower. 97 probability of profit for a $7 return. So next week is looking a whole lot better. That might be what I do with the money that's sitting in my portfolio. I have $10,000 that I've been trying to figure out what to do with, and I think selling NVIDIA puts is going to be what I do with it. I'm going to sell 2 weeks out, close it out every time it hits 50%, and ride it out up until it either breaks its pattern or I pick up shares at a price that I am willing to pay for it. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.